Hey everybody, Kevin here with another episode for you of the Real Estate Without Renters podcast. Thanks as always for listening to the show, liking the show, give me a nice rating if you enjoy the show, as a matter of fact, and please share it with a friend, investors, wherever you go. If you go to local meetup groups, real estate investment clubs, any investment clubs, quite frankly, because the note business should be a part of everybody's portfolio today. So thanks also for sharing the show. I do appreciate that. And don't forget, I also rebroadcast these on YouTube if you want to see the full video, and have a lot of other social media with my tip of the day. So make sure that you go to those, like those, and subscribe to that as well. I certainly would appreciate that. And I'm going to jump right into it today. I'm joined by two people. For those who are watching on the video, you can see that. I've got Dwayne Gibbs on there, and I've got Jack Krupey on there, and appreciate you guys being on here. Jack is going to be our featured interview today, and Jack and Dwayne and myself go back a number of years. I haven't seen Jack in quite some time, but Jack was around when the market crashed in the real estate, the 2008 wave, which really created massive opportunity for those who understood distressed real estate, understood the note business. In fact, in my opinion, it really elevated the note industry to where it is today, and there was a tremendous opportunity within that. But Jack also has a very interesting background, not only in real estate but also in Wall Street. In fact, if you go to his go to his website, you'll see on there Wealth Without Wall Street, and that's at JKAM Investments, by the way. That's JKAM Investments.com. You can check out his website, more about him and the funds that he runs out of that as well. So, Jack, welcome.
Thank you so much for having me.
I think I hit that pretty accurate about the last about the last crash, right? What the opportunities created.
Yeah, it was an amazing time. A little scary. I mean, I'd gotten into real estate a few years before, so I had a couple scars from sort of the crash, but it was probably the best thing that ever happened to me because November 2008, I got a job in a private equity fund. There were funds in New York that were buying all the non-performing loans, and they needed people with a real estate background. So I'm certainly not a Wall Street guy, just a blue-collar kid from New Jersey. Thought I was going to go into technology, but then the dot-com crash of 01 and just kind of fell into real estate, did all the wholesaling, fix and flip, landlording. So I lived that in my 20s, then was able to back into Wall Street and was really early in the non-performing loan space. We were buying non-performing seconds for 3 cents on the dollar in end of 2008.
Wow. Yeah, crazy. And you were also buying notes one at a time, smaller notes, or was it always with bigger firms?
Yeah, so I worked for that private equity fund for about a year and a half and really learned the business from that side. And then we were selling loans to other note buyers. So I saw how much, how great the opportunity was. So then I went on my own and really bootstrapped it with, friends and family, 100,000 here, bought a couple loans, 50,000 here, bought a couple loans. And then partnered with a small family office in New York, built up about a $2 million portfolio that we were buying and selling. So, we were buying a couple loans at a time. We'd buy from, the Condor Capitals, the Granites, just trading with other, smaller funds. And at that point, everything was kind of trickling down. The big guys would buy big portfolios and then they would sell, just sell downstream. And it just, fortunately, I took a meeting in New York one day and I thought it was a couple guys from Long Island that wanted to buy maybe 5 or 10 loans. And it turned out it was a group of ex-Bear Stearns guys that had $150 million and were looking to get into the business.
Wow.
And so we started a partnership with them, and we went from buying 10 million portfolios to 50 to eventually $3 billion worth of loans. Wow. It was an amazing ride that never expected to be involved with. We transacted with Goldman Sachs. We had lines of credit with Nomura and Goldman. We sold mortgage bonds to the character in The Big Short, the character that worked at Deutsche Bank. Sure. They changed his name in the movie, but in the book it's accurate. Greg Lippman owns Libermax, and we would buy portfolios of loans, and then essentially to refinance them, we would sell bonds. And so those guys were even buying our bonds. So it was a pretty amazing ride, and just a glimpse into how Wall Street works and how we were really the cause and solution of the financial crisis, because a lot of these loans were loans that were poorly originated. We were buying them, cleaning them up, and then eventually, re-securitizing them or selling them back to banks. And learned a lot, but, ultimately realized that, I'm not cut out for the Wall Street grind. So, was fortunate to move to Puerto Rico, and I got bought out of the company in a very tax efficient way. And, now, I'm still, somewhat active in the note business. I'm also active in the real estate syndication space, and just, enjoying life, love to travel. I'm a big points and miles guy too. So you'll see posts on my Instagram sometimes of flying first class. Usually it's on miles. I'm not, spending 20 grand to fly first class. It's usually flying for free. So just enjoying life, but still love networking, still love doing shows like this, love going to conferences when I can, and meeting up and give back to the community.
Yeah, I think Dwayne and I probably met you about the time you were doing more of the single off notes, smaller, I think is probably when we first met, because Dwayne and I trained together, for years, and would go around the country teaching people about the note business and get out to some of those national events. But him and I were always traveling. We missed a lot of those national events. Is that when you met Jack? Is that right, Dwayne? Your audio is not on, bud. All right, let me see. We can't hear you.
There we go. How about now?
There you go. There you go.
I think, Jack, didn't we meet in Vegas the first time? There was an expo that I think that was Noteworthy Convention.
Yeah, I think so. It was definitely in that 2010, 11, 12 range. Pretty early on in the business. And we were fast friends, and I was impressed with your your culinary expertise. You picked good restaurants. You knew what to order.
Yeah. No, it was good times, and everybody really was kind of scrambling. But to hear that inside from the the big players. I mean, you guys were a big player at that level when you're selling bonds and everything else, and a lot of people never understood the extent to that. Nor does an individual investor really need to understand that part of it and buying just a single note or a couple of notes here or there. But it's truly fascinating how that debt was packaged, repackaged, resold, and I don't know, on the big level, do you still feel that it was the smaller investors that really were able to turn the market around? Or do you think the big players were able to swing it that much? I don't recall the big players being able to swing it that much, because again, there was that trickle down effect, because at some point in time, you had to talk with people and get them paying again. And I bring that up because if we start to see another cycle coming through of non-performing notes, I want people to be informed that, hey, there is a model here that the small investor is absolutely necessary to correct a lot of these ills in the market, if you will.
Yeah, I think in the very beginning, while a lot of people got cleaned out because the stock market crashed too. So there was not, it was really a new industry. It's not that no one was buying loans before. There was the seller finance side of it. There was some distress, but it was really a new industry. The amount of distress was so much greater than any of the established players. I know Oaktree was a little bit early. Howard Marks has a great book on market cycles. So Oaktree was one of the early buyers of non-performing loans, but even then, like, the servicers weren't set up. There was not a lot of government regulation. There was not a lot of guidance even from the banking regulators on could they modify or not modify. So I think the smaller investors, regardless of it, if it was a fund and or the individuals buying 5, 10 loans from those funds, just the ability to be flexible, the ability to modify somebody that only sent one pay stub and not two, because there was so much bureaucracy we saw where good borrowers were getting turned down for no reason.
Yeah.
So that level of efficiency of being able to come in and just do the right thing and make a win-win for the borrower, that certainly helped. Now, whether it was the small guys versus the big guys, either way, I think it was just having entrepreneurial firms own the loans and direct the servicers to be smart and not just follow this random checklist and just almost sabotage good modifications because of just incompetence at some points. So that, I think, really helped the market. And when I would tell people what I was doing, everyone's like, oh, you're just like a Wall Street vulture. But overall, we helped a ton of people.
Yeah.
Anybody who could afford a mod, we helped. some people should have never bought a house. I mean, there were so many people who
100%.
got these liar loans. In
100%.
those situations, we did our best. We'd offer cash for keys. We try to work something out. Maybe 5 to 10% of the borrowers would dig their heels in and just be like professional con artists at this point and just try to live for free as long as possible. There's always some bad apples, but excuse me, I'm a little hoarse today.
Yeah.
But overall, I think, we helped people and we made money. And as a firm across the board, when we were small or when we partnered with a large firm, we actually made more money when we modified loans and then would sell those loans a few years later than if we foreclosed.
Sure. Yeah, it's like renovating a house. You buy a house that's broken, if you will, you buy a broken note and you fix it up and you've enhanced the value of it. And it did. I think it saved a tremendous amount of people from losing homes and everything else. And it's scary how history repeats itself, because more and more I'm starting to see those same kind of loans. They start to creep back in, nothing down, and all these other things. You're like, man, just don't set people up for failure. And that's really what some of those banks and Wall Street had a role in that too, but setting people up for failure. And we did. We had to come in, and I think it created overall. You're right. I remember people scrambling in service companies and not really knowing what to do, because, gosh, back in the day, you're right. Most people just, if you bought a note, you just serviced it yourself. There wasn't a servicing company. You're like, just send the payments to me, kind of stuff.
Yeah.
It was very loose. We were buying back before then, even lottery winnings and casino winnings and just all kinds of crazy stuff, Jack. I don't know if you knew that, but there was a big industry in that. Nothing that you could make full time, because there wasn't enough, lottery winnings and casino winnings to do that. But we dabbled in all those sorts of things. And I think ultimately, as that whole mess got figured out, I think the regulations that did come in the industry, although they overstepped a little bit, they retreated on some of those, has been good for the public. It's been good for the note investors. I think having the servicing companies get involved where you can make it more passive. I know that's one of the things you're big on too, is the passive income coming in. I think overall it's been really good for investors. And I think the recognition of the industry has grown to a point where I mentioned it casually in the beginning, but I'll say it again. I think notes should be a part of all investors' portfolios today. What do you think?
Yeah, I think it's definitely a great asset class. It's still there's still great opportunities. I think you either need to be really small. When I say really small, it doesn't mean like a one-man shop, but either really small or really big. I think some of the people in the middle that couldn't buy at scale but had a lot of overhead, maybe got squeezed, because there is a little bit less inventory than there was in the heyday.
Correct. Yeah.
But there's an absolute place for smaller investors as well. One of the things when we got really large, any loan under $100,000, we would discount it, just because when you have millions and millions of dollars worth of loans, it costs the same to foreclose on a $100,000 house as a 400. So we would sell those loans cheaper. And
Sure.
For entry-level investors, you're really doing a service to Wall Street. It's a win-win. Those loans trickle down, and you could get in on a nice quality house for a lot less.
And we weren't competing with you guys. We needed the bigger companies to feed us to get rid of, so to speak, that smaller stuff. And that still happens today, which is great for us. You have people trying to buy homes, real estate investors trying to buy homes right now, and they're competing with, BlackRock and stuff like that. It's like, how do you compete with them? You can't do it with us. We needed those big companies to buy the bulk and then to get rid of what they didn't want, which for scalable reasons you just mentioned, that was a big part of the model. I don't see that going away. I think that's going to continue on.
Yeah. And I think right now it's probably the least risky time. I mean, we were buying loans where almost every house was underwater, that debt was double the price. So you really needed to hone in on the value of the property and make sure you weren't, I kept repeating myself, you need to get the value right, and you need to make sure your title, that there's no back taxes or surprise liens.
Yeah.
In a way, it's a bit easier now because a lot more properties have equity. Now, we may not be making these 100% annual crazy returns where, you buy it, you get in and out in 6 months, but from an equity perspective, especially if you're looking for that passive income, getting, modifying, getting loans performing, you can still make solid, mid-teens, high teens, depends on really when the loans pay off. But there's really great returns out there on this paper, especially the paper that doesn't fit all the Wall Street boxes. seller finance, which I know is something that, has been around, is still around. There's some new regulations around it, but, Wall Street generally won't touch seller finance loans. And there's a lot of landlords or people who held paper for, to sell a house and they want cash out of it. Those are great niches. And, again, there's a lot of loans out there that don't check all the Wall Street boxes to securitize that end up available for, small funds and investors to buy. And, again, it's probably the safest time because there's a lot more equity built into houses, and we're a long way away from the last financial crisis, and we're in a different spot. I don't think residential is going to crash.
Right.
40% of homeowners don't have a mortgage, about 30% locked below 4%, and there's still a housing shortage. Other than a few markets, the construction never really caught up post 2008, so there's going to continue to be a shortage of housing. I think that's good for prices to stay stable.
Yeah, I agree. A lot of people in my industry were projecting this big wave of non-performings, and I kept looking, I'm going, I don't think so. You've got a lot of equity. It's a lot different this time around. And, government programs came back but you're right. I mean, on the smaller scale that Dwayne and I are seeing, you're buying performing notes right off the shelf, if you will, basically just buying and holding a note for 10 to 12%. But a lot of the notes I see are 30 grand backed by $120,000 house, so you're like, well, even if property values drop 10%, 20%, I mean, you're in good shape. So for the small investor, I agree with you. I think it's a great time for them to look at these deals and quite differently. And, the one concern on the banking side with the commercial real estate, now commercial in this aspect more, I know you're more multifamily, but in the office side, that's got me a little bit concerned there because it looks like 80% of that paper was owned by smaller banks. And we all know with office buildings, I mean, just look at the headlines, right? Big buildings selling for a third of what they were purchased for 3 years ago. It's kind of crazy. You have any insight on that side of the industry?
Yeah, absolutely. And that's actually good for investors that majority of commercial loans were portfolio loans owned by the small and regional banks. Residential, even if it said Wells Fargo, it was most of the time it was Fannie Mae or Freddie Mac. Yeah. Most of the loans were really institutionally owned. Right. And so by nature, it had to kind of trickle down from the top. But the fact that these commercial loans, whether it's office, warehouse, all of them, it's very, very dispersed. So it's an inefficient market. So there's a lot of opportunities if you can, whether you're tracking down the owner that's distressed and then going to the bank, or working the banks looking for opportunities. But I mean, office, there's going to be a ton of write-downs. I think at least there's a lot more guidance from 2008 on sort of how the banks can treat them, how their liquidity ratios are. So at least there's a playbook on whether or not the bank can take a loss, can they modify it? But I mean, the fact is, a lot of these are just going to need to get written down. Some offices may be able to be turned into apartments if it makes sense.
That's where I was heading with. On the conversion, you think that's going to affect the housing and the multifamily? For sure, right?
Yeah, I mean, I think there's still a shortage. So having, if there's a well-located office park that can be downsized, or you've got to build an apartment building and make it some type of mixed use thing. I mean, people are going to have to get creative. But, the large Class A offices, I think, are the ones in deepest trouble, because if those were bought at a 4.5% cap rate and they were 95% occupied 5 years ago, now, I mean, office, I don't know where the prevailing cap rate is on office. It might be 8, it might be 10. I don't know where it lands. And most of these buildings are maybe 50, 60% occupied, or, the amount of rent they're going to collect is significantly less because the companies have the bargaining power here. And I don't think offices are completely going away. I know some of my colleagues in New York are back to some back to 5 days a week, some 3 days a week. So it's not completely going away, but the level of space is going to be less. And, maybe 20 to 30%. You need 20 to 30% less office space than you might have needed before COVID. So there's going to be some amazing opportunities to buy. And, I'm not actively looking for office, but at the right cap rate, at the right cash on cash return,
looking at.
I think there's no bad deals. There's just bad prices.
Yeah. Yeah. So you saw after the crash, then you saw an opportunity really to diversify, and that's one of your funds is all about diversification for a passive investor. And I know you work with accredited investors in your funds, but pretty well diversified because you're lending money, right? You're also buying equity in properties. You turn around and sell properties. You're doing a little bit of everything in the diversified fund. Is that right?
Yeah, yeah, and I really tried to build it around my own personal portfolio. I was fortunate to have a liquidity event, so I had a fair amount of capital that I needed to actively deploy. And when I was on Wall Street, we couldn't take outside money. We had pension funds. It was like $10 million minimums. So I had a lot of my friends and people we sold loans to, people we sold REO to. A lot of people were interested in investing, and I could never take their money because it was all corporate. So I was excited to launch a fund to be able to have investors invest alongside us. And I go with when I was in the note business, and I'm still in the note business, but it was always no tenants, no toilets.
Mm-hmm.
I've also added no tourists because I know so many people who want to buy a single family house and turn it into an Airbnb.
Airbnb, yeah.
And for me, I wanted to be at scale. So I love the multifamily, the 100+ unit apartment complexes. They're at 100 units plus. You're at an institutional level, and it can be a truly passive investment. You have on-site management. It's like owning a business. One of our newest asset classes is we're buying marinas that have an RV park component. Very similar to mobile home parks and storage. These are mom and pop owned type of businesses that can be run a little bit more efficiently if bought with more of like a private equity fund and a corporate model.
Mm-hmm.
And if you buy enough of them, you could scale them up and you could sell to private equity at a much lower rate of return. So, I stick to just diversifying into multiple assets. We buy some loans. I still we'll look at loan portfolios, love the cash flow, love the upside. And, one of the reasons I dove a little bit more into the syndications is there's some pretty significant tax benefits for taking losses on paper. And I know a lot of note investors are also landlords. So I think the two go hand in hand together on managing your income tax and trying to plan and be the most efficient. So you're paying the minimal amount of tax that you are legally required to pay. Mm-hmm. And if you structure it right, you could even pay zero tax or carry forward a loss.
Yeah. Yeah, and obviously your move to Puerto Rico probably had something to do with that as well, with the tax incentives that they had there. I have a few friends that have moved down as a result of that, but it is something you have to look at from an investment standpoint as well. And in addition to your diversified fund, though, you also have a fund that people can kind of pick and choose what they invest in.
Yeah, it's a great concept. It functions more like a crowdfunding platform, but it's still technically one Reg D fund. And we have each individual opportunity, and everything is segmented per deal. So, right now we have a marina opportunity, we have a multifamily value add opportunity, and we have a hard money lending fund. And it's not the traditional single family house flip hard money lending fund. It's really a special situations fund. Mm-hmm. They're charging interest rates in the 20s.
Yeah.
And what we're finding is, if you're just flipping a single family house and it's a very cookie cutter deal, you could still get 12% money, maybe 14%, depending on the deal. But if it doesn't check every one of those boxes and you can't go to the traditional banks or lenders, the only thing out there is, a really sophisticated lender that can look at it, make a quick decision, and people will pay for that for a short-term loan for 3 or 6 months, especially if they have the opportunity to buy something at a deep discount and potentially make millions of dollars flipping a property. So it's a great option for passive investors. It's first position, and pays out double-digit returns to investors passively. So
yeah, yeah. There's always money out there. It's just the cost to it and what you put together. You look at business proposals and all kinds of things that people would have to put together, obviously, to weigh out what that's worth. But with that lender mentality, you're always thinking, well, if we got to take it back, we're good, right?
Yeah, absolutely. Yeah. And like you guys, I think one of my missions is to get more people into alternative investments.
Yeah.
Whether it's performing, non-performing loans, whether it's the syndication space. I mean, up until 2012, it was really difficult. They were really just country club deals. But with the law changes, with the 506C and the ability to advertise, I think not enough accredited investors have enough money outside the traditional, stocks, bonds, and traditional financial system, where there's so many layers of fees and so many people getting paid, and there's just there's better out there than trying to do that Vanguard, earn 8% on average when you could still have a 20% drawdown. I mean, 2022 market was down 20+%. It was up 20 something in 2023, but on a 2-year basis, people might have grown by 2% if they had their market in both years. So get excited about your 23% last year, but don't forget, you basically made nothing for the last 2 years. And there's plenty of alternative investments. You could have been spitting off 10, 12% both of those years, and you're significantly better off than if you just had your money in the market.
Yeah, I agree. And I switched gears, as did Dwayne, about 4 or 5 years ago. And, one thing I recognized at the level that I work at, which is the individual investor, is they need someone with the experience to walk them through the deals and one-on-one. And that's what I've been doing really for the last 5 years is, all of my clients can schedule Zooms with me and we get on, we go through documents. I mean, so we really get into the details there. And I think that's a big part of what you're saying, which is most people don't know about this business. And when they hear about it, it's unfortunate. Some people just dive right in and find out it's not investing in real estate completely. There's a different side to it. Is it papered up, as you indicated earlier? Is it written up the right way? What are the true values of things? All that stuff comes into play. So what I've been able to do is utilize my experience to go through and really just walk people step by step through this. And I think that's what's going to get more people involved in this business. And Dwayne's obviously helping me out with that. He's come on board as well, because it just hasn't existed in the industry before. And I think that's something that's got to be a game changer, because I guarantee a lot of people, because it's happened in the past, that will learn at that level will be the next people like you, Jack, that get into funds and everything else. But with a cautionary tale there, you hinted at it, but some of these smaller funds, you got to be pretty careful of what you're thinking of. Getting 5-10 million in a fund can be really tough to manage, because you're not big enough to play with the big boys, but you're too big for the individual stuff, and it can run into a little bit of a management issue. You were never really stuck in that range, but you have familiarity with it.
Oh yeah, absolutely. And cash drag, I mean, that's one of the biggest issues. If you take all the money up front and you can't deploy it, then you're either your returns are terrible or you're forced to do bad deals. So I definitely warn investors, don't take on too much money. If you have a fund that has multiple closes, or you can kind of have a capital call list and kind of take money in as you go, it's always easier to raise for an individual opportunity as well. And I say that as someone who actually, our diversified fund is technically a blind pool fund. At least when it starts, there's nothing in it. Now we've got 10 assets in it, so we can show our current portfolio, and it's a little easier to raise. But we basically do a new fund every year to year and a half, so we're kind of starting over. But even with that fund, when we have a new deal, I still talk to investors about the deal and say, now is the time to come into our fund because we've got this great opportunity. So, I think slow and steady wins the race. But the key is you just got to start taking action. The only way you're ever going to get to a $10 million fund is to do a couple deals yourself, do a couple deals maybe in small partnerships. When I raised my first 2 million, I was coming out of 2008, had lost, a good chunk of money, was licking my wounds a bit. I'd worked in a fund, but, it wasn't like I was making millions of dollars working at a fund for somebody else.
Sure.
But I tracked the deals I did. And I also had a few clients that I was bird dogging, if you will, and found them loans and helped them with them and was able to use that as a track record. And when I raised the first 2 million, I showed a track record. I was like, hey, these are deals I personally have money in. These are deals I managed for another investor with their money. And that was enough. The investor didn't care. He just wanted to know the numbers good enough. He understood that I was coming in with mostly sweat equity. So just getting involved, learning, tracking real deals, and that's the best way to kind of build up your track record if you're starting from zero.
Yeah,
and obviously partner with the right people. Yeah, and in a community like yours too. There's like a level of vetting rather than just go to some RIA club where you've just got a bunch of usually there's a couple good successful people and there's a lot of wannabes and yahoos at some of the real estate clubs. But when you're joining an actual community that's cultivated, that's been a big help for me. I've been in a number of masterminds over the years. I think in 2022, we were paying almost 6 figures between all the mastermind groups I was a part of.
Yeah. Dwayne, I know
Hey,
your
Kevin.
connection's a little shady there, or a little shaky, but
It-
you had some questions. Yeah.
Yeah, I was getting ready to say, I had an investor meeting a week and a half ago with some friends that live down in Charlotte that they have in their portfolio, they manage about 1,900 doors. And we were sitting there talking and you know, they said, listen, I really want to start learning the note business, but I need to scale it way back because I don't want to go out and create a fund where I don't have experience in and put all this money into it. But yet I need to be able to diversify because they're having a problem with finding inventory and it's creating a problem for, the monies that they do have sitting there. So 100% agree with you on what all that looks like for these investors of having to change what they're doing in today's market.
Yeah. And future wise, again, as you said, you don't see a big crash or even really a crash at all in the residential side. Equity being the savior, I guess, on that. But I tell you, we've seen really steady inventory levels, consistent inventory levels, which I've never seen previous to the crash. So that's been nice. It's been good, steady. But you're right. I think the funnel that's been opened up are these smaller real estate companies that go out, buy real estate and sell it with financing. They're creating notes on that in the mom and pop notes. So those funnels of inventory have really accelerated where the bank inventory that we dealt with back in the last crash, that spigot's kind of been turned way down. So we're just making adjustments. And I know in your business and in your funds, that's something that you have to look at all the time too. What's going on in the market?
Yeah.
Where do I adjust? Where are the opportunities?
Yeah, I mean, right now, there's also a lot more commercial opportunities. You mentioned community banks with commercial,
Yeah.
but also those non-bank hard money lenders. There's a lot of maturity defaults on hard money loans. There's hard money loans that the sponsor didn't just couldn't execute on their business plan. So there's opportunities there. Now, those are a little bit more hands-on
Yeah.
than buying a performing loan, obviously. But for those that are really looking for those home run returns, I mean, those are the scenarios where the bank is going to be more motivated.
Yeah.
So
But your experience,
those of you that
those
are,
lenders don't really want the property back, right? I mean, they could, but they don't want it back. They'd rather just sell the problem, right? Yeah.
yeah, especially a half-finished renovation project. So, I find a lot of note investors also have real estate, construction, house flipping backgrounds. Some are more, the engineer kind of accountant types. But for those interested in note investing that have that construction background, that's a golden opportunity right there. And I think that's, as lucrative as early days of the financial crisis, if you could find the right opportunities where you're backing into a solid property that just didn't execute on the business plan property.
Yeah. Excellent. Yeah, I hadn't thought too much about the hard money, but that's an interesting angle to it. So I'm definitely going to research a little bit more into that. Dwayne, you have any other questions? I know we're keeping Jack long here, but enjoy it.
No, I mean, I think it's good insight of what he's, seen in the past and now where he's at now and reflecting back of how kind of was a stepping stone for you being able to go off in some different areas from your education from the past of being smaller and years into it. And it's just not jumping into it overnight. It took some time and really understanding the market.
Mm-hmm.
Yeah. And I never set out to grow that big. It just sort of happened. I think is what happens is once you just got to get in and take action in a smart way.
Surround yourself with the right people too, right? Yeah.
Yeah. Doing a couple deals could lead to that, that bigger deal. Doing 10 or 20 deals, brokering some loans, bird dogging some loans led to a few $1 million, but that wouldn't have happened without jumping in, buying the first one. Yeah. Even my first job in private equity wouldn't have happened if I didn't jump into real estate in my early 20s and just I was just out of college doing the low money down, read a Robert G. Allen book on, no money down real estate, called my college landlord and, back in 2001, 2002, if you could fog a mirror, you could get a mortgage. So I had a couple loans pretty quickly and, just got into the business. So, but having good mentors and good communities is a big help towards being successful for sure.
Great. And we'll leave it at that. We've been talking with Jack Krupey, everybody. You can find out more about him, his company, his funds, all of that at JKAM Investments.com. Is that the best place, or is there any place else that people can learn more
Yes,
about
yes,
you?
and we have we have an ebook about distressed market cycles. So I'd encourage everyone to download. Its free ebook if you go to the website JKAM Investments, and we're also on all major social media. So if you're a Facebook user, Instagram user, YouTube, we have all of those under JKAM Investments. And my personal page, I still post a lot of business stuff as well.
Great.
So find me and friend me on any of the platforms of your choice.
Great. And you have a podcast as well, I thought I saw?
Yeah. It's called Alternative Investor Mastermind, and would love to have you guys on in in the coming weeks and chat more about you and your business and expose you to our audience.
Sure. Fantastic. All right, everybody. Thanks again for listening to the show. Dwayne, thanks for being on with
Jack.
us as well. And Jack, it's been a pleasure. Good to see you again. It's been a long time.
Real pleasure. Thanks a lot, guys.
You bet.